When you think about your stocks, you probably think about buying them, selling them, and that's about it, right? But what if I told you there's a whole other life your stocks could be living? One where they actually earn you extra income while just sitting in your account. Okay, let's dive into this often overlooked corner of the market, stock lending.
No, really, think about it. For a lot of us who are long-term investors, our shares could be put to work, rented out, basically, to other people in the market, generating a little extra cash for you. And you don't even have to lift a finger.
So what is stock lending? Well, at its core, it's pretty much exactly what it sounds like. You give your broker the okay to loan out your shares to other folks who want to borrow them for a little while. And in return, you get paid a fee. It's kind of like being a landlord, but for your stocks.
Okay, so how does this whole thing actually work? You might be thinking it sounds complicated, but it's surprisingly straightforward. Most of it happens completely behind the scenes, handled by your broker.
It all kicks off when you decide to opt into a program. From there, your broker basically plays matchmaker, finding a borrower who's looking for the exact shares you own. Now, step 3 is the really crucial part. The borrower has to put up collateral to secure the loan. Once that's done, you start earning interest every single day. It's a small but steady little income stream. In this collateral, this is your big safety net. We're not just talking about covering the value of your shares. We're talking about more than that. It's usually something like 102% to 105% of what your stocks are worth. And it's held by a neutral third party. So if something goes wrong and the borrower can't return your shares, that collateral is there to make sure you're protected. All right, so that all makes sense from your side, the lender's side. But what about the other side of the coin? Why is there even a demand for this? Why do people want to borrow stocks in the first place? The number one reason, and it's not even close, is short selling. A trader thinks a stock is going to go down, so they borrow your shares, sell them immediately, and then hope to buy them back later at a much lower price. But it's not all about betting against a stock. Traders also borrow shares for really complex strategies like hedging or arbitrage, or sometimes just to make sure the basic plumbing of the market keeps flowing smoothly. Okay, let's bring it back to you, the individual investor. It sounds a bit like free money, doesn't it? Well, not so fast. As with absolutely everything in finance, there's a trade-off. So let's take a hard look at what you get and what you have to give up. The main reward is right here, plain and simple, a passive income stream. This is from a real brokerage statement showing those daily interest payments trickling in. And look, for certain stocks that are in really high demand, the interest can be significant, adding up to some serious extra cash. But let's have a reality check here. While some people can do really well, for most of us just holding regular large-cap stocks or ETFs, the income can be, well, pretty tiny. I saw one person on Reddit post their monthly earnings from lending out a bunch of different stocks. Their grand total, 22 cents. So yeah, for most of us, this isn't going to be life-changing money. This really lays out the decision you have to make. On one side, you've got that extra income, which is great. But on the other side of the ledger, you've got a list of things you're giving up. And some of these, like losing your voting rights or your investor insurance, are a pretty big deal. Let's break those down. So let's get into these risks. First up, your voting rights. They're gone, at least temporarily. They go to the person borrowing the shares. Second, your dividends get complicated. You get what's called a substitute payment instead of a real dividend, and that's usually taxed as regular income, which is often a higher rate. And finally, and this one is huge, your loaned out shares are often not covered by standard investor protection insurance like SIPC in the US. You're pretty much just relying on that collateral. Now, these risks are important for individuals, for sure, but the real drama, the big story here, is happening on a much, much larger scale. We're talking about the giant institutional players, the index funds and pension funds that own huge chunks of the entire market. And this quote from a Columbia Business School study just nails the dilemma. These massive funds, who are supposed to be responsible stewards of the companies they own, face a tough choice. Do they exercise their power by voting, or do they chase some very lucrative profits by lending out their shares instead? The whole game changed back in 2019. The SEC put out new guidance that basically gave these big funds a green light. It clarified that they could choose not to recall their shares for a vote if the lending fees they'd lose out on were high enough. That was a massive shift. And get this, the key number from that Columbia study is just staggering. After the SEC gave its blessing, institutions started supplying 58% more shares for lending right before shareholder meetings, the exact moment when having a vote matters the most. And just to be super clear, this wasn't happening to every stock. the effect was almost entirely concentrated in those companies that are heavily owned by index funds. For them, the supply of shares available to borrow shot up from 15.6% all the way to 22.3%. That's a massive increase right when it counts.
Okay, so the big institutions are lending more and voting less. So what? Why should we care? What are the ripple effects of this quiet but really powerful shift?
Well, here's why it matters. These big index funds are supposed to be the stable, long-term shareholders. They're the bedrock. But when they take their votes off the table to make some extra money from lending fees, it can throw corporate elections, especially the close ones, into total chaos. A voting bloc you could always count on suddenly becomes a complete wild card.
And this all leads to a final, really important question. The whole system of corporate governance is built on the idea that shareholders hold management accountable. But if the biggest shareholders of all have a direct financial incentive to sit on the sidelines and stay quiet, it fundamentally changes the game. It really makes you wonder, who is truly steering the ship?